An index fund is a mutual fund or ETF that follows a passive strategy designed to track or approximately match the returns of a market index such as the S&P 500. It does this by holding the securities that make up that index, rather than trying to pick winners. The goal is to match the market, not to beat it. An ETF, or exchange-traded fund, is an SEC-registered pooled investment that trades intraday on a national stock exchange at a market price. That market price may sit at a premium or a discount to the fund's net asset value, so the price you pay or receive may not equal the NAV. In short, ETF describes how the fund trades. A common misconception is that index funds and ETFs are separate, competing things. They are not. ETF describes the trading wrapper and index fund describes the strategy, so a single product can be both. The Vanguard S&P 500 ETF, ticker VOO, is an S&P 500 index fund that also happens to be an ETF. The expense ratio is the percentage of a fund's average net assets used each year to cover operating expenses, including management fees, 12b-1 distribution fees, acquired fund fees, and other costs. It is not a separate bill. It is deducted directly from fund assets, which silently lowers your return, and that is exactly why it is easy to overpay without noticing. The SEC puts it plainly. If the holdings of two funds have identical performance, the one with lower costs will generally generate higher returns for the investor. Even small differences in fees and expenses compound into large differences over time. Major broad market ETFs reflect this, with VOO and VTI each charging just 0.03%, while the Morningstar Large Blend category median fee is about 0.67% per year. A front-end sales load is deducted at purchase. The SEC's own example shows that a $10,000 investment with a 5% front-end load means only $9,500 is actually invested. Reputable low-cost index funds and ETFs charge no load and no 12b-1 fee, and 12b-1 marketing fees typically apply to mutual funds rather than ETFs, so loaded share classes are worth avoiding. According to the SEC, ETFs are generally more tax efficient than mutual funds because they buy and sell portfolio securities through in-kind exchanges rather than for cash. This means they typically generate fewer capital gains distributions and therefore lower taxes than mutual funds. In a taxable account, that difference can matter. This is general information, not advice about your specific situation. An S&P 500 index fund holds the 500 leading large U.S. companies. A total market index fund instead holds large, mid, small, and micro-cap stocks representing nearly all of the investable U.S. equity market. As an example, the Vanguard Total Stock Market ETF, VVTI, tracks the RSP U.S. Total Market Index and held roughly 3,500 stocks as of March 31, 2026. A frequent assumption is that the broader total market fund will clearly outperform the S&P 500. In reality, because the S&P 500 makes up the large majority of total market value, the historical returns of the two are very close. The real difference is added small and mid-cap exposure, not a guaranteed performance edge. Passive index management usually means less trading, more favorable tax consequences, and lower fees than active management. The case is backed by data. Per the SPIVA US Year-End 2025 scorecard, 79% of active large-cap U.S. equity funds underperformed the S&P 500 in 2025, and taxes only widen the gap. According to a separate report, S&P's after-tax scorecard for year-end 2024, the median active large-cap core fund trailed the index on an after-tax basis over every measured horizon by up to 4.4% a year. Note that index funds themselves can still lag their own index slightly due to fees, trading costs, and tracking error. Where you hold these funds matters. For 2026, the 401k employee deferral limit is $24,500 and the IRA limit is $7,500, with higher catch-up amounts for older savers. Remember that index funds and ETFs are not FDIC insured and can lose value. FDIC's $250,000 coverage applies to bank deposits, not securities. Before buying any index fund, the ECC advises reviewing all fees, fund-specific risks, how the index is built, and whether it fits your goals, and reading the prospectus because not all index funds are low cost.